Hi everyone, welcome back to this week episode of the Accounting and Tax Helpdesk, a podcast provided by Alamir CPAs and Associates. Today we're gonna discuss the post-tax season adjustment and the financial strategies that you can use after using your tax returns. When you file your taxes and you got your tax return from your CPAs, you need to basically look at the big picture, basically see the revenue trend, where the money come from, where the money is spent on. But most importantly, you can use the tax return, review the deduction that your CPA used, and maximize those deduction, and have a saving on the tax payments. Your tax return tells the story, so it's not the only the compliance document. You can use it as a roadmap. You can review your where the money comes, where the money how much money went out, and what's left out. It's basically your financial GPS that you can use it to avoid costly events. When you get your tax return, you can basically look at all the simple data: revenue, cash flow trend, tax, the expense pattern. But the two most important item that you can extract from your tax return is your tax efficiency, and also is your deductions. So basically, if you look at your tax return and you're spending too much money on your taxes and your tax liability is too high, uh, something may be off. You might not be planning right in your tax planning. So make sure, compare the percentage of tax payment to the IRS to your bracket, and make sure you are efficiently using all the deductions. After the filing, you basically, any business owner needs to review the tax return. Basically, the tax return has not all the statement, all the schedules, and the schedule are a standard, like the payroll, entertainments, travel. So you can basically review all those buckets and see where you have a spike and where you have a decline. Investigate that spikes and decline, and make sure if it's in benefits of you, keep going to that route, to in that way. If you think it might be affect you in a bad way, consult with your CFO and make sure you prevent that before the major disaster happens. Tax return can wave a red flag in front of you. You need to be careful to see that red flag. If your business is not efficient, you're paying too much taxes. If your business it's efficient, you can save lots of taxes. Basically, I put an example. You're making $1 million and you spend $400 on taxes. Something's off. Why is off? You are not using a deduction. You are spending your personal money on the business instead of the business money for a business, and we cannot commingle the money or bank account. So these efficiencies you need to be careful of, and making sure you are not wasting money on taxes without any good reasons. So when you get your tax return, I emphasize that you need to review your tax return. I understand that most of the business owner, they are busy on working on the business and dealing with the day-to-day activities. The best way to review your tax return is basically get the summary of your tax accountant, but make an appointment with your CFO, go to the office, and have the CFO review it with you and explain everything with you. To save time, just email the tax return to your CFO and then schedule a 15 minutes, 20 minutes call to have a quick review and health check on the accounting. Having said that, if you have any question, if you don't have any CFO or fractional CFO, feel free to reach out to us at helpless@alamircps.com. We are happy to help you to make your business more efficient and making sure you are making good money. Tax return can give you the overall picture of your business. It can give you the high level profit margin, high level cost saving, and high level the revenue. But if you want a detailed understanding of your uh, margins, the best way is to map your tax bucket to your projection and your forecast using the chart of account mapping and the tax schedules uh, to understand the more detailed profit profitability and the margins. I know I just use a lots of fancy words, uh, but you and it's if it's gonna be a time consuming process. It's gonna take few hours from your time. So make sure to delegate that to your bookkeeper, to your accountant, your CFO to get that data. But make sure you use that data and the data is accurate. The reason I'm saying that tax return is a legal document and it's a financial result of whatever happened in the past year. I know you forecast, you have a bookkeeping, you have everything, but tax return is something that you file it with IRS. So make sure by tracking the profit margin, gross margin, and mapping to your books, uh, it filed accurately, and also you have a true understanding of your business. Most people they just overestimate uh, of their revenue and just making sure like the expenses they are just discounting all the expenses in their mind and they think they have the very healthy financial. It might not be true. So just make sure to map that tax return to your forecast and actual financial results. I mentioned before that you cannot commingle personal money with the business money. The reason is you're gonna lose a lots of protection and lots of tax deduction. The best way is when you open a business, just go to your bank and open the new business account, bank account, checking and saving, and also get the credit card. Uh, Make sure that credit card is in your wallet, so every time you're going for a business expense, use that credit card. Uh, Make sure all your employees they are using your corporate credit card, or you have to reimburse them on a timely manner. I personally prefer a corporate credit card. You can minimize it. You can have a better control of the financial. But if you by using these steps, you are avoiding very costly expenses. For example, you go to the car dealership and buy a car from your personal bank account. It's very hard to prove to IRS that that car is a business car and I need to deduct it from my business. But if you use the business bank account and make the payment monthly on your business account, it's a proof. It's on your bank statement. It's on your books, so it's easier to track. And also, your tax accountant uh, are not gonna chase you for answers where this money come from if it's your business, if it's your personal account. As I mentioned, you need to map your tax return to your financial data. And also your tax return is the document that's filed with government. So it's a true document, it's a true factual document. So you can use that as a foundation of your next year budgeting, next year forecasting. And if you have a 2, 3, 4 years tax return, you can basically have an idea of your growth rate and apply it to your forecast. And it gives you more accurate data in your reforecasting and financial planning. When you map your data to your tax return, it's a very technical activity. It's very time consuming activity. So your CFO can help you to refine the mapping and automate it. And also, there are all the financial KPI that I mentioned in the previous episodes. Feel free to check it out. Those KPIs, your CPA or sorry, your CFO using the tax data can give you the true evaluate of all those KPIs. So it's a real number. It's not a fake number anymore. You can manipulate book as you want during a year, but when it comes to tax return, everything needs to be reconciled and it should be accurate. So Otherwise, you're in trouble with IRS. So we are not gonna lie to IRS. That's why it's very important your CFO to redefine the KPI and compare it to the monthly KPI that you used in the past 12 months. And with that, you can start the projection. It should be close enough. When I say to match the numbers to the historical data, it's not gonna match the penny. The reason is tax CPAs, they are using some IRS code to maximize deductions that in the financial planning we are not using those, but it should be close enough, it should be in the range. For example, tax accountants, they might use a different method of depreciation to bring your tax liability down. It's a very legitimate way to reduce your tax liability, but in financial world and the real world, we might not do that. But you need to know uh, those differences to come up with the more accurate picture of your tax returns. So the KPI is not going to match the penny, but it should be within a range. The range is depends on each industry. For example, a gross profit in a construction company might be 20%. Your tax accountant might change some of the labor costs or material costs to bring a different bucket. So your gross profit in your tax return uh, might be 15%. It's still within a range. So if you're in a construction business, your gross profit should be somewhere between 14 to 20%. If you are in a service industry, your gross profit should be between 40 to 55 or maybe 60%. So if you are within a range, it's still acceptable. But if you're way off, then you have to question. And these are the metrics and the knowledge that the fractional CFO or CFO might have, because they are dealing with all type of industry, and they can compare it with the different clients and see if you're off or better. Uh, if you do it yourself, you're basically spending a time that you want to work on your business into the nitty gritty accounting of your business. And that's why it's really important for you to have a fractional CFO by your side uh, to have a to obtain a knowledge of the all different industries. Yes, the fractional CFO, they maintain the confidentiality of the clients, but they can guide you with the different industries, different clients number. They can compare the number internally and then give you the advice. uh, it's basically one of the best investment you can do in your life. All I just mentioned is to make sure you compare your tax return to your financial data and make sure you have a health check. However, don't wait for a tax return to check your KPIs and the financial data. You should do that at least on a monthly basis. You cannot wait until till tax return until your tax return, otherwise you're in big trouble. uh, but tax return is a scorecard. It's a end year result. It's a season finale of the game, so you can compare it. But if you wait to the tax return to compare all the KPI, you are in trouble, my friend. Having said that, your goal is to make a long-term business and make sure you achieve your your life goal, your life financial goal. So, as I mentioned during this episode, don't wait until the uh, end of the year to get your tax data. Use your tax return as a business scorecard. Review it. Make sure you're winging it. You're not winging it. You're winning it. And stop whining. Plan ahead. Make sure you're winning the game. Thank you so much for listening to us. I look forward to talk to you in the next episode of the Accounting and Tax Helpdesk. As always, make sure you like, subscribe, drop a comment, and if you have any questions, send us an email at helpdesk@alamircps.com.